In the beginning, I, like many people, engaged in what I laughingly call midnight gardening. I took my gold and silver physically and I stored it at home. Then I came to hear about incidents where other people who were engaging in midnight gardening had visits from people whom they wouldn't normally invite over for lunch. People often that had guns, which meant that I was exchanging one risk for another, and the other was unacceptable. I began then storing physical gold and silver in bank safe deposit boxes, real true segregated storage, segregated to me. And I stored it legally with disclosure outside the United States because I thought that my physical precious metals should be separated by my person. With COVID, I learned that there are some access problems with regards to storing one's physical precious metal outside of one's domicile. So for me personally, I have most of my physical precious metals held in certificated form by proxy in Sprott products because they're tax efficient for a US person. But this whole concept of trust, what I like about the distributed ledger is that the trust factor is verifiable and it doesn't rely on, as an example, an unallocated storage program where your physical precious metal isn't actually physical precious metal, but rather the obligation of the dealer. I don't have a huge sense of humor for that. It's great for people to do if they're comfortable with that product. It's not my business to tell them what to do. I want to publicly thank my friend Tika Tuara, who some years ago took me through the value proposition around crypto and convinced me to participate. My crypto speculations, I wouldn't call them investments because I wasn't intelligent enough to be an investor. I was a speculator. My crypto speculations gave me so much more than I deserved so fast that I decided that I would exchange that surplus for surplus that I understood better. You know, if you enjoy the rapid appreciation in an asset where you don't understand the value proposition, you aren't richer, you're just more exposed. And with Bitcoin at one price, it was to me an interesting speculation. With Bitcoin at 10 times that price, it became almost an obligation. I had to do something that I didn't know how to do, which was ascertain the value of my cryptocurrencies. So currently, I'm not smart enough to justify in my own mind the valuation of the cryptocurrencies that I was a minor, successful speculator in. I can understand if you were more technologically sophisticated, if you understood more the construction of the algorithm and the value proposition offered up by each individual instrument. But I don't. It's taken me 45 years to become a value investor in natural resources and conventional financial services. And I suspect that I don't have 45 more years to learn the same range of lessons in cryptos. Just on the margins, Patrick. First of all, I don't think that crypto and gold and silver compete with each other particularly, except for the very, very marginal speculative buyer, the narrative buyer. The value proposition in crypto is all around the size of the network and the possibility of frictionless exchange. The value in gold and silver is very different. They are mediums of exchange that are simultaneously stores of value. But the truth is that they're both fringe assets. It's estimated that the market value of all savings of asset classes around the world, investment and savings products, exceeds $500 trillion. So the value of crypto, as an example, is now believed to be about $1.5 trillion. Think of crypto and gold and silver each as being as relevant to the total pool of savings and investment capital in the world as a pimple is to an elephant's behind. They're both tiny, tiny, tiny asset classes. It's interesting to note that for me, part of the attraction, probably with crypto, but also with gold and silver, has to do with the fact that they are such small asset classes. If you look at precious metals, currently precious metals in the US market comprise less than 0.5% of savings and investment products in the United States. The 3-decade mean is alleged to be between 1.5% and 2%. So gold doesn't need to win the fight against dollar-denominated conventional savings products. It just needs to lose the fight less badly. It just needs to regain its 3-decade mean, which I think it's going to do. I can't speak to what the market share of crypto will be. I will just say that the market shares of both relative to other asset classes are infinitesimal. And I don't think that the competition that gold and silver will face as stores of value will be with crypto. I think it'll be with the S&P 500. 40 years of bull markets have taught people that if you buy an index of the largest and most profitable companies in the world, companies with pricing power, that those companies are adequate stores of value. I'm concerned as to whether that or not that's true, given the valuation of those companies, and given the fact that some of that valuation is due to artificially low interest rates. That notwithstanding, I think that the competition that gold and silver faces is not from crypto, but rather from large cap equities on a global basis. The government exists because they have a legalized monopoly on coercion. And to the extent that the state has to use brutal methods to defend itself, it will do it. If it can rely on deception as opposed to coercion, that's of course better. So in terms of the first part of your question, from their point of view, they have discharged their obligation with regards to the task that was assigned to them very, very, very well. I think they've done it in a way that will incur great cost. I think that debasing the currency through quantitative easing, by the way, Patrick, if you did quantitative easing, it would be called counterfeiting. You'd be thrown in prison. The way they have done it by increasing debt and deficits. These debts need to be paid off. I remember famously former President Obama saying that the debt didn't matter because we owed it to each other. That's wrong. The spenders owe it to the savers. We don't owe it to each other. One class owes it to a different class. And so you either steal the savings of the savers or you default. So that part of what the Fed has done is wrong because they haven't managed the balance sheet. They've kicked the cash, they've kicked the can down the road. And then finally, stimulating the economy with artificially low interest rates and artificially high liquidity means that what you've done is you've stolen demand from prior years and front-loaded it to this year. It feels good this year, but you have to steal the demand or create the demand again next year and the year after. What I'm trying to say is eventually I think we're going to have to pay the piper. And I think that the piper's bill is going to be very high. So I think that the job of the Fed becomes progressively more difficult.